Time for a little coverage on what happened this week. Uh, the title of this one's going to be All Roads Lead to Inflation. So we had, last week we did this on Stan Druckenmiller, and this week another macro legend and someone that I've been fortunate to know over the years. Did an interview on CNBC, and a lot of important things I think came out of it. A lot of similar themes to Stan, but probably more importantly to me, there's a lot of nuances in what Paul said. So I'm going to go through that. Obviously, cover the trades that he talked about, which I've brought up here. This inflation theme to me is really important for people to think about. Whether you're a trader or whether you're thinking this long term for your portfolio, it's important. After that, I'm definitely going to go through the AI side in terms of the power needs. There was a podcast I listened to, is the best one I've seen recently on energy, so I want to highlight that to you. And then I will finish with Bitcoin and just make sure that since Paul's brought it up, Stan didn't say he was long it. Paul said he was long it, but I'm going to go through the inflation argument for Bitcoin. But also, there was a deal this week in the payment side, which is really important. So, again, he came out and said all roads lead to inflation. If you haven't listened to the interview, you should. The main reason behind it is because, as he said, and I guess the next one will have it there, we are going to go broke regardless of who wins the election. So, regardless of who wins the election, the math behind where we are as a country in terms of debt means something's got to be done. And his point in the interview was no matter how you play around with the numbers to try and balance the budget, it's not going to work. And so the question is then, if it's not going to work and they're not trying to do it, what's the end result? And circled there at the bottom as part of it. And I agree, and this has really been the theme of everything over the last 4 years. The only playbook to get out of this situation is to inflate and outgrow the debt burden. He specifically mentioned that we've seen this playbook from Japan. He talked about historically, it's the only way to do this. And so for people who are investing, who are trying to think, the point of this is really that the river of macro is flowing one direction going forward. There's no way out of this situation other than to find ways to inflate your way out. There was an article at the beginning of the week from another person who I've followed since my days in Brazil when he was with the IMF, which is Mohamed El Arian. And he basically did an op-ed in the FT on why we should be paying more attention to gold. So again, the way that I like to approach markets is to look at what the assets are doing and think about where the trend is. There anything that can change that trend, and is everyone on board? And his point is, and he starts this off with highlighting what's known out there, which is central banks are driving gold strength and gradually diversifying the reserve holdings away from the dollar. I've showed this before on various charts. But it's an important thing when people are moving away from the dollar. The IMF came out with a report, their annual fiscal monitor, and it's titled Putting a Lid on Public Debt. And it has a chart in here which highlights, and there's two things to look at. One is just, you can see the global median in terms of, this is the percentage of GDP. And this red line here is the US, sitting now at currently at about 120% of GDP. You have China, which is lower but growing rapidly, and we're seeing more stimulus, and they're taking on more public debt, or willing to take on more public debt at this point. Again, because they're kind of forced in this situation, this is the problem. Do you give up on and put the economy into a significant contraction, or do you just continue to have the debt grow? And with the printing press, this is what really took this off, and it just continues to go. So in the US, before the great financial crisis, we were about 60. Paul mentioned that 25 years ago we were at 40. Well, now we're at 120, and you can see the forecast going forward. He specifically mentioned this website. If you want to go to it, you can go and play around with all of these: defense, domestic, healthcare, Social Security, and see if you can come up. His point was there's no way to make this work. And so, if there's no way to make it work, you have to think as a trader what to do. Now, for historians like Neil Ferguson, I mean, he wrote this in June, but he's talked about this forever. That once you get to the point where your debt service is more than defense, it's a problem. And here's where a chart that he's got Ferguson's law. We crossed over in 2023, and now it's just going to continue to get worse unless we have interest rates go lower. So Paul's point was they don't really have a choice, like Japan, which tried to raise rates recently, and we had the yen carry disaster that went on in July, and now the yen is starting to weaken again. And I think as all of this stuff is starting to play out, people are starting to realize more and more, okay, how do we play in this? It just changes the mentality in terms of thinking which way the macro side is going to be, and not from necessarily a doom and gloom scenario. One difference between Stan and Paul, Paul did say he owns no debt, and I've talked about kind of the trades that I think about, but shorting bonds as opposed to being long assets, there's a difference in there. Right now, Paul's thing was he's long commodities, he's long gold, he's long Bitcoin, and he talked about something else, which I'll bring up. This is just the something from Bank of America this week, just highlighting the gold inflows, the 4-week moving average, and just how large it is. So a lot of people are diving into gold at this point. Just looking at those trades that Paul mentioned, since really the acceleration of from pre-COVID to now, this is the Barclays Ag unchanged. So if you've invested in bonds, it's unchanged completely. Here's what's happened to gold and the S&P. They're both up about 80% since just before COVID. So you wanted to have the assets. The short on bonds has not been the trade, even though we had inflation. They're just not producing any returns. I added this. This is the same chart. I wouldn't want to put Bitcoin on the first time because Bitcoin has outperformed by 840%, or is up 840% since 2019. So if you really wanted to have the best hedge by far, you wanted to have Bitcoin over gold and over the S&P. In terms of where we are for the year, this is a unique year. Gold are the blue. These are yearly returns. Gold so far through late Friday was up 33%. S&P was up about 22% year to date, not in total returns, just in price appreciation. We have never had a year where both the S&P and gold have been up 25% or more. We've had 20% years, but you're sitting at a point where you have both gold and stocks going higher. That kind of unique scenario just says that, I mean, it argues that there's too much money in the system, and so it fits in the point that the debt is large. We have too much money in the system. Here is gold, and the one thing about commodities, Paul talked about commodities. He said they're incredibly underowned. I agree with him. You're going to need to have a change in crude oil because crude is really the weight on commodities at this point. I brought this chart back. This is 15 years of the relationship between gold, copper, and crude. Here's crude right here, which is basically the same price as it was in 2014, at the same time that we've got gold going higher. So you've broken away. I've mentioned copper as a theme here, which I think will play out over the long term. But in particular with China, the main thing is going to be in there. I'll go through some of that as I continue. And this is the most important part of where the commodity trade is now. I've shown this chart for a while. This is the overlay between the red line here is gas at the pump. The blue line here is the second contract of the unleaded gas futures. The second that that unleaded gas futures bottom, and we start to see a trend higher at gas at the pump, which I would think would be happening sooner rather than later. When that happens, I think you're going to start to finally have the next phase of what I'll call going forward. I'm no longer going to say risk on, risk off. I've seen that too many times from people, and it keeps the bears alive. I'm going to call this as inflation on or inflation off. And right now we are in an inflation on situation. When gas at the pump goes higher and rates are going higher, and the Fed is kind of trapped the way Japan was. I think in the US it'll be an inflation off scenario. In Japan, this whole situation gets into a weaker currency. So I think you want to watch gas at the pump, and a leading part of that is unleaded gas futures. So once we get some kind of a change there, that'll be the big story. And as you get into energy, I recommend listening to this podcast that I listened to the other day with Dr. Anas Alhaji on Macro Voices. It was the best kind of current and future look at oil that I've heard. It seemed very unbiased. More importantly, he discussed the geopolitical situation in the Middle East and talked about that. He's had a good call on that over the course of the last year in terms of it not leading to oil going higher. He highlights a lot of parts of how important China is and why you should be watching China now to see. But probably the most important thing he brings up is the recent report released by ExxonMobil on their energy outlook. And he specifically talks about this. And I just want you to start with sensitivity analysis. The economic effects of this kind of supply shock would be dire. This is an important thing to read, and I'm going to go through why, because there is a convergence that's about to happen in the course of the next 5 years based on everything we're seeing. So this is specifically about the fact that production is coming down, and it's going to come down sharply because of the investments that are going in. So specifically, they mention oil production naturally declining at a rate of 15% a year, double the IEE's prior estimate. But it is the lack of investment going forward in this area. Think about a lack of investment happening in the energy side at the same time that we are having a massive boom in innovation investment in the AI side. The historical relationship going back thousands of years between innovation and power. There is a complete linkage between the need for power for any new innovation. And AI needs, as we know, a lot of power, and we are not investing. So the money that we're printing is being forced to not go into this area. So even though oil prices are not going higher now, we're not seeing anything in the change. And I do believe in the long run that we will have efficiency gains from AI. The likelihood of getting those and changing away from fossil fuels that quickly makes no sense. And so at this last line here, at that rate, 2030, oil supplies will fall from 100 million barrels per day to less than 30, 70 million barrels short of what's needed to meet demand every day. This has to be watched. Oil has to be on your screen. And from a portfolio perspective, you should be long energy at the same time that you are long these inflation trades. I think the only way that this can end, that we're going to end up getting points where bonds start to sell off and stocks go down is when energy prices turn around and start going higher. And so I think you want to be long energy. You're getting paid lots of dividends. There's a lack of investment in the space, which should keep prices at least stable to higher. And then any tail risk that happens in there is going to be big. You also get the China part. So I've shown this chart before. I just want to re-emphasize the fact that the white line here is China's fixed asset investment in real estate. It's been shrinking at 10% a year. They are trying everything to get it up at least to here. If they get it to here, and you listen to Dr. Al-Haji's conversation, any change in China to get it back up to 5% GDP, he says it's going to be a big impact to the energy side. So it's a place to look into. And the reason I brought up the AI side, we know it's growing, but it's expected to more than double data electricity needs by 2030. So if you've listened to the Eric Schmidt thing that I highlighted, he's joked about the fact that we won't have enough power in 5 to 7 years unless we make the investments in it. And so what that's leading to is an arms race in the nuclear side from Microsoft, Google, Amazon. You have a tremendous amount of activity that's happening. And that's why when Paul Tudor Jones mentioned that he believes people are using the NASDAQ as an inflation hedge, he doesn't get into the reasons behind it. But I do believe that the reason is because AI synthetically is an inflation trade. Yes, it will lead to disinflationary periods every single day on the software side in certain places. But for the fossil fuel side and the energy side, we're just not there. So commodities is the variable, the thing that matters the most. When it starts to go higher, the problem is the service stuff is going to be very difficult for AI to have an impact on in the short term, things like healthcare, insurance. It just doesn't work that way. You're not going to have the big impact. Yes, it'll have an impact on the ability for certain physical goods to be cheaper, but the reality is being able to keep inflation at a lower level is a problem. So when inflation goes high, it's going to be an issue. Now, in terms of looking at the Mag 7, the reason I want to bring this up, here's a inflation off trade. Here's an inflation on trade. When AI started, which is basically right here, right in here is when the release of ChatGPT came. We had an increase or doubling of the market cap. So this is in market cap. So we're now at $16.5 trillion. The reason I bring this up is the Mag 7 is the inflation hedge using AI, or it's one of them. So you've got the NASDAQ, which Paul mentioned. I think it's absolutely an inflation hedge. And the core, when you say, I want to be long Bitcoin, Paul's very good at noticing that things are moving a certain direction with inflation. Well, all we hear is that Bitcoin is risk on, risk off, but we never hear that about what's happening with the Mag 7. We think about that with stocks. These are inflation hedges. As long as they're printing money and they're refusing to raise rates and they're refusing to fix the deficit, the money's filtering into the system. AI is having all this money being spent by the Mag 7. They're the ones that are seeing the benefits quickly because they already have the investments there and they can see it. So you're getting this correlation between Bitcoin and the Mag 7. It's just that Bitcoin moves faster than the Mag 7. And it's more liquid in the fact that you can trade it 24/7. The Mag 7 and Bitcoin up here. Here's how the other innovation, just picking a few of the innovation arguments. This is XBI, which is the biotech side. I still think this is going to move higher at some point in here. I don't know what the driving factor is going to be, but it has not moved up with them. Neither has this, which is the altcoins within there. So you've had a separation between the altcoins and Bitcoin. Bitcoin has gone higher because Bitcoin to me is an inflation hedge and it benefits a lot from what's going on. And then on the other side, you have ARK here, which again is the Kathy Woods Innovation ETF. So even though innovation's moving higher with AI or the mega cap, the Mag 7 and Bitcoin, you're not seeing it on the other parts. And I think that's because of inflation. And if you want to have a true AI type trade or true inflation, I do think that the Mag 7, which is really going to end up being the NDX. And NVIDIA's growth just continues. And again, you can think of NVIDIA as the purest play in the AI growth. And Apollo put this out this week, just highlighting that the market cap of NVIDIA is almost as big as every other country in the G7. Here's the correlation between NVIDIA over the S&P and the S&P. So the S&P does well when NVIDIA over the S&P does well. And until that changes, which you look at the NVIDIA versus the S&P chart, which is back up to the highs. As long as NVIDIA continues to go and the AI growth is there, it's just going to pull it up. This is another one of the Mag 7s, which I think people are underestimating as an AI trade. They had their robo-taxi thing. I heard everyone crap on it and say it was horrible. And now Tesla had this huge gap. I think I use Grok daily. I use it as one of the 3 AIs that I use on a daily basis. And I use it for different things, mainly in Twitter to source out information. But to underestimate Elon Musk at this point with everything that he's done with data centers, what he did with the SpaceX the other day, he was one of the original founders or funders of OpenAI. I just think to ignore what Tesla's doing and not think that we're going to continually playing this whack-a-mole thing where there's a new AI leader all the time making advancements. Tesla was the one for this week. A brief thing on the stock market. I'm not really going to go through things because we're before the election. There's not a lot that's going to happen. The earnings are coming out. Stocks charts look great. I still think we're going to break higher post the election, whether it happens the day of or a couple weeks after. It doesn't really matter to me. But I did want to put one thing on the earnings since they've started and just highlight again that JP Morgan, this was a summary they put out this week, just highlighting that the estimates, there's been downgrades persistently, and you've got the year-over-year projection now down to 4%. It was 8% not that long ago. Cyclicals in defense around 0 to 4, and then you've got the Mag 7, which is down from 36% for Q2, but the forecast is still for 17%. So this has been a Mag 7 world, not only in terms of market cap, but in terms of benefiting from the earnings. And I don't see any kind of major change, even though I do think from the election with China, you could get a small cap outperformance for a period of months. I don't think it's sustainable because I don't think the economy is going to pick up on that side in any meaningful way unless China really goes crazy. I think that'll take some time to see, but for the time being, I do think the small cap should outperform post the election period. Just a reminder that the seasonals kick in now. So I'd shown this chart on a prior video. I just want to remind people again because we're there. This one as well, November and December, typically very good months. And the buybacks, and just so you see, the buybacks on pace for a record year. And the reason, and a lot of the reason that the fourth, specifically November and December, are so big is because you get these very large buybacks at a time when seasonal slowdowns kick in. And so the buybacks start to dominate the flow. So just keep it in the back of your mind. Once we get through the election, we've got the MOVE index and the VIX at higher levels than you'd normally have. I do think you're going to see the normal seasonals which kick in unless we get a change in inflation. And since I said gas at the pump, there's still more to come down. I just think this is going to be a situation that without some kind of a shock wave, you'll find bids underneath and the buybacks will take over and we'll see vol come down. Substack this week, Miles Brundage wrote, I think, a really important thing. I retweeted it. He was at OpenAI, he left, and I just want to highlight a couple things in here because his Substack, he brings up a lot of different important things. AI could enable sufficient growth and early retirement. And I want you to just, as you read through it, these are things of someone who's worked inside. So I see all these tweets coming from people who are fading AI and continue to say it doesn't matter. And if you guys are reading that, you got to read people that are working in these companies and going through it. His whole paper in here is really something important in terms of what it means for the work argument. He's making, should eventually remove the obligation to work. Everything that he's talking about is how we are going to have a dramatic change in the job situation in the world, which I think everyone's been worried about. But the reason, or where this comes in, is he's saying it's not something that's going to happen. Oh, I left it out up here, I think. This part here, I think it's likely that in the coming years, and he specifically writes not decades. That's when you hear things like that, coming in years, not decades. Don't ignore the fact that profit margins are going to explode for the stock market. When you start fading what's going on, unless we run out of power, which is not happening yet, and may happen in the future, you've reached a situation where the AI capabilities are improving very quickly and policymakers need to act more urgently. And regardless of his angle on this, from the basis of what he thinks, why policy people need to get in, the point of this is someone who worked at OpenAI says this is moving very quickly. He specifically mentions AGI. All of this stuff should have you thinking about, okay, we have inflation, which is guaranteed, and we have AI, which is moving incredibly fast. What does that mean? So on the one side, Bitcoin has always been talked about as an inflation hedge. But whenever I try to explain to people that I view this as the purest AI trade, here is something important to get your hands on and go through, which is a Bernstein Black Book. So they're known for putting this out. They did a very long one on Bitcoin and why you should have it. And this came out this week. Some of the points in there, mentioning that it's volatile, all the things that you've heard. In terms of risk on, risk off, the inflation hedge, a hedge against political stability. They go through all of that, but the angle that's the most important, Bernstein's now also shifts focus towards Bitcoin's future role in what's called the compute economy, moving beyond its traditional function to store value and becoming an essential part of the global computational landscape. This is the important part, is that this is now, because of the blockchain, being viewed the way it should, which is as a part of the AI world. They also, Bernstein, spent time in September talking about how their view was that crypto's unique features are ideally suited for the complex requirements of machine-to-machine transactions in the AI community economy. Again, I've said this before, Bitcoin is part of an ecosystem, call it the AI economy, which is going to have not only artificial intelligence, but the crypto side. They are connecting the two economies, and we are at the acceleration point in this stuff. So you have this point where AI is converging with crypto. And one of the ways that this showed up, that the payment side Bernstein talked about, I did a special video on Friday. It's on the YouTube video channel, going through the Stripe acquisition of Bridge. This is not just for crypto people. This is really important because this is part of the bridging between the fiat world, the macro world that we know, the TradFi world that we know, and crypto. And so if you haven't paid attention to stable coins, it's important. That's what this was all about. Bernstein wrote this after it. Stripe's acquisition Bridge validates the usage of stable coins. We're going to have more cross-border payments. I go through why this is important for emerging markets, why it's important for the macro side. It's definitely worth going through. Volatility, which Bernstein brings up, I just want to highlight that if NVIDIA is the most important stock in the world right now, here's the overlay of volatility. And this is just taking a rolling 200-day volatility between the two assets, meaning NVIDIA and Bitcoin. Bitcoin has been below NVIDIA vol since 2022 by a significant amount. So when people are saying Bitcoin is too volatile, they're also investing in NVIDIA. Everyone should have at least 5% of their investment portfolio, in my opinion, in Bitcoin. They all have it in NVIDIA just by the fact that if they own SPYs or they own QQQs, they're getting that much in there. So Bitcoin should not be thought of as its own thing. It should be, or as just some volatile asset. It should be thought in the same way that you own something like NVIDIA or something like Apple or something like anything else, in my opinion. And that's the technology side. Just two final things. Microsoft also has an important thing coming up. They have a shareholder meeting coming up in December, and on the docket is to vote on adding Bitcoin, adding Bitcoin as an investment for Microsoft. The board is trying to get people to vote against it, and I just bring this up because you've got Michael Saylor putting out that if you want to make the next $1 trillion, shareholders call me to put pressure. So that's it for this week. We'll see what goes on as we get closer to the election. But inflation has been a story. I just wanted to give you guys enough information of connecting the inflation part that Paul said to AI, to crypto, to the energy side. Energy is the main thing to watch. I'll come back and see you guys next week.